There's a moment that happens in a WhatsApp group full of people who think about money differently than anybody else does. And it reveals more about how infinite banking actually works than reading any book could ever explain.
So it started with one member posing a car problem in our little group chat. And what followed was 7 people posting their opinion on what course of action he should take. And every single answer said something about how that person valued capital.
Some people read a thread like this and they see a car repair debate. And then there's the kind of person who reads the exact same thread and sees a lesson about sunk cost, opportunity cost, cost versus value, and what money is actually for.
Today, we're reacting to a real conversation in our own IBC community.
So here's the scenario. One of our clients, Travis, just paid off his wife's 2018 Ford Edge this month. It's got 105,000 miles, and now it needs a new engine. It's going to cost about $6,500 to $8,500. And the trade-in value right now is only about $5,600.
So the gut punch is, you just paid off this car, and now it needs a major repair that likely costs more than the car's actual value. So the question becomes, do you sink money into a dead automobile, or do you buy a new car and thus have a new payment?
Paul, that's kind of like asking, should I buy more term insurance after my old policy times out? In other words, should I put a new engine on a worn-out chassis? It sounds like a lot of risk. Maybe I should have just bought right in the first place. Let's get into it. Paul, what's happening, my brother?
What's up, man? How you doing?
I'm good, man. I'm real good. It's August already.
The summer has just breezed by. It's unreal. And we dipped into the 70s the other day, and I was like, uh-oh.
Really?
Fall's kind of, yeah, just for like 12 hours, and then it got hot again. But it was actually kind of nice.
Yeah. No, it's been hot here, but we can't complain because we know winter's around the corner. I love fall here, though. It's kind of sad to see summer go, but at the same time, it's a little bit like, okay, summer's kind of exhausting. Like, I don't care who you are. If you have kids, summer is tiring. I don't know why it's so tiring, but it is, man. Like, it's
They always
fun.
want to do stuff.
They always want to do stuff. Yeah, you got to go on vacation, go to the pool, go to the lake. Yeah, but it's a lot of fun. It's just tiring. It's kind of nice to get that. Then you got to do all the yard work and everything. And then, once fall hits and everything stops growing, then you got more time on your Saturday and Sunday. So,
yeah, on the yard work piece, I have given up cutting my grass due to the extreme slope of my backyard. So
yeah,
I've gone back to it's just too much. I've pushed it. It's just, and it's not like 1,000 square feet either. It's a lot to push and a lot to mow, and I can't use my riding mower back there. So I have given up. I'm going to sell my mower to another business that I have. And I'm okay with that, for the record.
And just hire somebody to mow?
We do.
Yeah.
And they make nice stripes, and it looks nice. They do all the edging and weed whacking and stuff, and which I enjoy doing all that. I just, I'm going to pay someone $80 a week to do it.
Right. I love looking at the freshly mowed yard, but when I look at it after I mow it versus when somebody else does it, it looks the same. It's like, I like it just the same. So might as well get somebody else to do it.
Yep.
I like it.
Yep. And as long as you keep oil in the mower, it'll be good.
Who knew? I thought they made oilless mowers. I think that should be the next thing they make. Hey guys, David here. Hey, thanks for listening to me and Paul talk about all things infinite banking. I just want to drop a quick note to tell you about a second podcast I've started. It's called The David Befort Show. My new show will bring you inside the minds of successful entrepreneurs, financial experts, and real leaders who've earned their stars and scars, and will share their lessons learned and the framework they use to produce real results. And you're not going to want to miss this, because I'll be asking these expert questions that nobody else is asking. You can find The David Befort Show on the exact same platform you're listening to right now. Thanks for checking it out. Now back to the show. All right. Well, hey, let's get into it, man. We had a pretty entertaining WhatsApp thread a couple days ago. And that's what I love about this group of people we're connected with, is the way everybody thinks. And, people aren't afraid to throw out an issue they have or a problem or something they're trying to solve, and just get feedback from a bunch of other people who aren't there to judge you. They're just there to offer their own I don't know, from advice from their own experience. So it's a lot of fun. So we had one recently where Travis, one of our clients and somebody who's been on the podcast before, a lot of times I think he throws these things out there just to start conversation, even if he already has an idea of what he wants to do,
Yeah. And Travis is a smart guy, right? Practices IBC, been doing it a while, has some other things going on. He's a pilot, so he's a very intelligent young guy. But he's got this thing about new vehicles. It's like, I don't like the depreciation. I just don't want to. And I get it. I mean, it really is a crapshoot. I can remember my parents. You buy a new vehicle, you drive it off the lot, 20% is gone from that vehicle, right?
Right.
So I get it, right? And a better way might be and we're going to get into it a little bit. This is not going to be an episode about, what type of vehicle to buy. That you can go listen to Dave Ramsey for that kind of information. So this is going to be a choice.
Yeah. Speaking of, last, I haven't heard lately, but I remember, not too long ago, his idea was, hey, your first car, go buy a $3,000 car. And in 3 years, you sell it for $3,000 and buy a $6,000 car. There's a lot wrong with that statement. That's exactly what his advice was, though.
First, it was,
where are you going to find a $3,000 car that actually gets you from point A to point B without any maintenance over the next 3 years and resell it at the same value? Like, give me a break.
Has he adjusted those numbers for inflation, meaning I mean really post-COVID?
Yeah, I don't know. Inflation? I think because I remember reading that advice probably pre-COVID. So I'm wondering if now it's go buy a $10,000 car, because that's what you got to spend to buy anything that's going to last and not give you headaches, too big of headaches. That's just the state of where things are when it comes to cars. But so Travis has some choices here. So he threw out his problem and just let people just throw their responses out. So we wanted to go through some of those and really highlight this is such a different thread, because everybody commenting on this thread practices the infinite banking concept, which means they think completely different than most people do. And they come at it from different perspectives. And mostly because they have more options than other people do. Like what are the options most people have when it's time to go get a new car?
They're going to go down to the dealer and let's face it, most people aren't paying cash, right? Most people borrow money from a third party, right? Use the dealer finance, or you go to your own bank and you get financing there and you borrow money, right? So you go into debt and you buy a new car or maybe a certified pre-owned vehicle or whatever, maybe even a used car, but you go into debt to go do that, right? And that's what most people are doing.
Yeah. So there's that.
In other words, you have no choice.
You don't. And I was just talking to a guy a couple months ago, a friend of mine who's not practicing IBC. I think he might listen to the podcast occasionally. But he said, our car broke down. We had to go down and buy my wife a new car like within a day because we had to have a car. And he said, I had to sit there and cut a check. I think he ended up paying cash. Maybe he got financing. But he's like, his words to me were, I didn't have a choice. Like, he was put into a corner. He didn't have a choice. He had to either cut a check and pay cash, get that new car, or it wasn't new, it was a used car, but buy that car or get the financing from the dealer. Those are the only two options he had. No other choice. Yeah. And he said, that will be the last time that happens to me.
Yep. There's a far better way. And, something on the used car thing as well is generally you get less favorable interest rates from lenders. Right? Yeah. So new car rates are new car rates. They're better. Used car rates are not as good. So he might have been at 8 or 9%. Who knows?
Exactly. Yeah. So let's look through some of these, because it's just fun to show some of these threads, and I'm going to go through them. We can go through them in the order that our producer put them together here. And if you're watching on YouTube, you'll see them on the screen. So maybe you want to head on over to YouTube and give it a watch. But, we had Andy respond, hey, you could donate it and take the tax break. and not sure if it's worth throwing good money at it. Depends on whether or not the rest of the car is in good shape. So he brings up a good point. Like, hey, there's maybe a tax break you could get by donating it. Or if you do repair it, how's the rest of the car? Is anything else going to break down? So what's the next sequence of events that happens after this?
Right. Yeah, there's, you get up there in miles, and I think we're at 105,000 miles. There's other things. We didn't even talk about the transmission in this car, right? How's the transmission, right? Has it ever been serviced? All these things. So there's these other things, and I guess it gets down to risk, Dave, right? It's the cheapest decision we can make in this case might be to repair, put a new engine in it, but it could be the most risky. So there's all these other intangibles, I think, that, what do you value though? Do you value, certainty, guarantees, and transfer of risk, right? As opposed to, well, I'll just do the cheapest thing possible and just roll the dice.
Which is what most people end up doing. Like, I mean, to draw a parallel, it's like term insurance. That's the cheapest option out there. But does it actually become the most expensive option? Well, I'd say in 98% of cases, it really does, because 98% of the time, a policy owner outlives their term insurance and therefore has $0 in life insurance at that point. And it's either, hey, buy a new term policy that's going to cost you a lot more than the last one because you're a lot older now, or it's going to cost your heirs a ton of money in a death benefit they'll never receive because you decided to go cheap and take the least expensive option at the time, which actually turned in to be perhaps the most expensive option long term.
Yeah, and unfortunately, that's what most Americans are doing. They're listening to the wrong advice, and they're assuming that this guy's got a big following, so what he's saying must be correct, or this looks good on an illustration. I'm going to buy this, universal life policy because it looks great on paper, but do they really understand all these second and third order effects as going down the road in life 30, 40 years from now? And the thing I hear, Dave, all the time with the buy term and invest the difference camp is always, well, by the time I'll self-insure, by the time I'm whatever age, 60 or retirement age, I'll have enough in my investment portfolio to self-insure.
What does that even mean?
I don't even know what that means.
Does that mean your family doesn't need any more money than what you're going to leave them out of your 401k?
I don't know what it means, but there's a lot of assumptions and ifs in there. Like, if this, then I can leave them my house. If this goes right, I can leave them a little bit of my 401k. If this goes well, I can leave them a little bit of my Roth IRA maybe. But you really have no idea if any of those things are going to come to fruition and be true. You have no idea.
Hey, everybody. David here. I just want to take a few seconds and introduce you to a community that I'm a co-founder of and I've been a part of for 6 years now. Many of you listening are already members and you know what I'm talking about. I want to introduce you to CoSpark. Real financial strength comes from owning the structures that everybody else pays into. CoSpark is a member-owned commonwealth, a community where your participation builds towards real ownership stake in businesses and assets that are acquired and in capital. Look, I'm a member because I believe in it, but dive in for yourself and check it out. Go to cospark.us. That's COSPARK.us. Now back to the show.
So anyway, back to the car. I guess I would relate it to, I would say that you don't know, going back to his option of repairing, putting a remanufactured engine into a car that has 105,000 miles on the chassis and the transmission and everything else comes with a certain level of risk. Where's the engine coming from? Who rebuilt it? What did the engine look like before it was remanufactured and had new components or used components put back on it? So you're putting a lot of unknowns into this new powertrain package, and then you're going to install it, and it maybe comes with a 90-day warranty, maybe a year warranty. I don't know, but there's so many unknowns. I don't know if the risk is worth retaining you're no question. You're saving a lot of money, in fact, but it depends on what you value. You may be just going through the same thing a year from now. It's like, oh, now I definitely need a new car because this remanufactured engine blew up or the transmission went, who knows? So Yeah.
Well, we had one person Stacy, who chimed in because her and her husband, who are clients of yours, I believe, right?
Yeah.
Actually had this exact same issue. Said we made the choice to drop a new engine to our Jeep. It never ran quite the same. Older parts needed replaced frequently. Spent about $10,000 on the engine, and about another $1,000 to $2,000 a year for the next 7 years on repairs. Until we were told the repairs would just cost. It was basically totaled. Repairs would cost more than what it was worth. Right? That's the definition of a car being totaled. So we sold it to a junkyard for $125.
Man.
And then what'd they do?
Yeah, they went out and got a new vehicle, right?
Yep, with a policy loan.
They took a policy loan and went out, got a replacement. I think they got. I want to say this is when they got a new like diesel Suburban. I think is what they got. If whatever it was. And then, quickly repay the policy loan with cash flow. And now, their powder's been dried out and they're ready to go for the next opportunity. And hopefully that vehicle lasts a long time. But it's, it's under warranty. It's new. And let's face it, Dave, is there anything better? It's kind of like getting a new policy. Is there anything better than that new car smell?
They say it's the most expensive smell in the world, but it's good.
It's good. Every time you get in, you're like, or you buy a new vehicle, you go on vacation for a week, you come back, you crack the door, and it's just, man, It smells good. God.
Yeah.
And it's plastic and leather, but man, it smells delightful.
Yeah. I mean, you could just get a leather air freshener and put it in your car. But you'll know it's not real.
Yeah, it's and who knows what's in that those ingredients that are in those things.
Oh yeah, of course. So there's also the option thrown out there about, hey, buy certified pre-owned. So let somebody else pay the depreciation, and now you still have certified. It's got a warranty, so you got peace of mind there. And all of this, what it all comes down to is there's the cheapest option, new engine. And then there's the next option, which is buy a better car and spend more money right now. So what's fun is when they started going back and forth into these different strategies that could be used, because not only, if anybody's seen Travis on our show several episodes back, I don't know, our producer can tell me the actual number of the show, and I'll let you know. But he talked about a program he does involving notes, and I do that. Paul, you've done that, and it's just another way to put your capital to work in something that's going to generate a consistent monthly payment to you at a certain interest rate, and you can use that now to maybe fund the purchase of a new car or repay your policy loan, whatever it may be. But he had so many different options. It was like you take all these different ingredients and the order in which you mix them created a whole new dish. And so the thread went through all the different options. It was great.
Yeah, it really did. And just some creative people. And we had talked about on the podcast long ago of kind of using an asset. And that can mean different things. It could be a note. It can be a cash flowing business that you buy, bread delivery service, or, whatever it is. And that is generating a certain amount of monthly income to you. And you could use that to finance this new need that you have, right? Whatever that need may be. Maybe the air conditioner in your house went and there was, $8,000 to $10,000 out the door that you were able to finance, same as cash, for 12 months through your air conditioning company, whatever. And now you've got some sort of cash flowing asset to make that monthly payment. So it's like not coming out of your pocket every month from your labor of your day job. So I love that. I love that idea. But again, getting back to what you said earlier, is there's just optionality when you practice IBC and you have, liquid capital that you can access. All these other options, you can kind of take a step back and like, listen, worst case scenario, I can take a policy loan, get a new vehicle, no problem. On my terms, repayment schedules on my terms. Maybe I can take advantage like one of our other clients or one of your other clients did, where he used the dealer finance, got a $2,000 discount, took a policy loan a week later and paid off the note, and now has the deed or the title to the vehicle in his pocket, owns the vehicle outright. So there's just all these other intangible things in the financial landscape that you begin to see because you're thinking differently and you have, dry powder, as we like to say, right? You just can sit back and like, well, let me see how it plays out, right? And maybe you get some dealers competing on the new vehicle and they give you a better price for the certified pre-owned and who knows what can happen. But you're doing it from a position of strength. We always talk about that too. You want to be in a position of financial strength so that you can be clear-headed and mindful of all these other options that you may or may not.
Yeah. And really, you said worst case scenario, take a policy loan. I'd say worst case scenario, do what everybody else does and go get bank financing.
Yeah, maybe that's a better way to put it, actually. I was thinking, just go finance it. Easy.
But the easiest option and the one most people practicing the infinite banking concept choose is, well, shoot, I've got the capital available. I'm going to take a policy loan, go buy that car for cash, own the title, and I'll repay the loan on my own schedule, which often means a lot faster than I would pay a car loan off because it's beneficial for you to pay this off quickly because that money's there for you as soon as you pay it back.
Yeah. Do you want to, if someone's listening to this for the first time, they have no idea so when you take a policy loan against the cash value of your whole life insurance policy, right? You control the repayment schedule. When you make a repayment, it's a principal only payment that goes back to the lien the life insurance company has placed on your cash value. So you get to use that money again. So think of it as a kind of a more like a interest only line of credit borrowing scenario, but you're in complete control over the repayment schedule. You're not repaying yourself, but you are freeing up the capital that the life insurance company has placed a lien on. So it is in your best interest to repay policy loans as soon as you can, because you can use that money again for something else.
Just like getting a home equity line of credit, the bank places a lien against your home for the amount that you've taken out. But this is even better because it's impossible to default on this because that asset backing that loan is always going to be worth more than what that loan is. Guaranteed. And the repayment schedule is entirely up to you. Now, we always say that, and a lot of people think of that as the advantage of, well, shoot, if it's entirely up to me, maybe I just won't repay it. Well, you could do that, but then you're not playing honest banker, and then you can't recycle that cash. So it's funny, that's usually the first thing people think when they learn about this concept, and then when they start really getting into it, and then especially practicing this concept, they say, I don't have to pay this loan back at any certain time, but you know what? I want to pay it back, and I want to pay it back as quickly as possible because I never know when my wife's car is going to break down and I'm going to need to access that capital again to go buy a new car. So I might as well just pay it back as soon as possible. It doesn't hurt me. It only helps me, and it's available when I need it.
Yeah. And the other just real quick intangible advantage is that you are repaying money to a company that you're part owner of, and that's going to pay you a dividend, and it's guaranteeing the collateral, which is the policy. So there's all these other advantages to doing it this way as well.
Yeah, 100%. I wanted to read one comment here from Paul Fougere. Is that how you say it?
Which one are we reading?
Paul Fougere that says, replacing a mediocre Ford engine with another one seems like a terrible idea. No, that's just coming from a car guy. Apparently, he's a little opinionated.
That was purely, I've owned Ford. They're totally fine. It was more just, I think that particular motor, I was making the point where I think they've had some issues with that 2.7 EcoBoost twin turbo here and there. And this is proof, right? Now, again, who knows how it's been treated? I don't know. It sounds like they drive it gingerly, but they're in the Texas heat. It's a twin turbo. They're running regular discount gas in it. Who knows? I mean, I don't. But free chicken here, folks. If your car's recommended oil change interval is like 12,000 miles or 15,000 miles or 10,000 miles, and you're abiding by that, I really think you should cut that in half and do it like every 5. And there's going to be people that disagree. That's fine. I don't care. But oil's cheap. Engines aren't.
And everybody thought this was just a banking channel. No, we talk about cars too.
Yeah. Airplanes, cars, planes, trains, and automobiles.
Yeah. You're going the wrong way. How do they know where we're going? So I want to get to a part of this that really changed the entire conversation. We've got one client. He's a client of mine, actually, one of my probably earliest clients. He's a wise older gentleman, older than us, and much wiser than us. And when Antonio spoke up, he said something that stopped the math in its tracks. Basically, the money should stay in motion, but that's a secondary thought. The first thought, primary thought, is the people you love. Because in our experience, math isn't money and money isn't math. A lot of times, money involves more than just math. If you only relied on math, you might as well just be what Dr. Spock, right? Just logical, making these math decisions based on what the pencil equations you write on paper. There's a lot of other things to consider when it comes to money, like family, loved ones, peace of mind, certainty, safety, all of that. And that was the point Antonio brought up to all of us. We're not young, but we're younger. Is, hey, you really got to think of this from your wife's perspective. You're putting your wife and your children into this car. If you put that as priority number one, what now becomes the best option for you? And that hit home to me. And I couldn't agree more with Antonio. Yeah. I love it.
Shout out to Antonio. He always, I feel privileged to be in the same community with him, but he always has something smart and just insightful to say, always. And it's spot on. There's all these other unseen things that go beyond the math, beyond the depreciation, beyond certified pre-owned, new car, new engine, whatever. All these other considerations kind of vanish when you say, well, what's the best thing for my family to get from point A to point B safely to the destination? Because maybe we're taking a long road trip. You're always going to be in the back of your mind. All right, this car is getting kind of long in the tooth. What's going to go next?
Yeah.
And it's a Ford. So it could be anything at any moment.
Well, hey, even the healthy of us, even that dude, Brian Johnson, that guy who wants to live forever. You ever seen him? I watched this documentary on Netflix.
He looks like he has a serious vitamin E deficiency, doesn't he?
Yeah, he's pale as pale can be.
No,
he was just diagnosed with some like incurable disease that's eating his stomach alive. So everything that he's tried to be the healthiest man on earth, he still has a disease that's incurable, and he's probably going to die. He thought he would live forever.
I'm just going to keep eating Entenmann's donuts and whole milk and see how it goes.
There you go. One of the best things from Antonio's quote here is being cheap isn't loving. So that's a powerful statement, because I might get accused of being a little too fiscally responsible sometimes.
He's showing himself a lot of grace, folks.
Yeah.
Dave's not as cheap as he used to be. I mean, he used to be.
Yeah.
But maybe it was, better than the alternative,
I had to come around to it, but I realized, you know what? Some things are worth spending money on. Quality actually matters. Like, quality is important. Quality in the things you own, they're going to last longer. So it's actually going to be a cheaper purchase over the course of time than buying that less expensive thing up front. And depending on what it is, like for some tools, I'll go to Harbor Freight for some tools, because I'm only going to use them a couple times. Right?
Yeah, they're fine.
Yeah. But if I was going to use, like, I've got a DeWalt drill, cordless drill, because I know that it's a good drill. I use it all the time, way more than I really want to, and it'll last forever. So
that's right.
Some things are worth it.
I couldn't agree more. Not sponsored by DeWalt or Harbor Freight. Maybe we should be, but yeah, it's the old saying goes, you get what you pay for, right? And we all have our brand loyalties, and mine. I'm a Mopar guy first and foremost, but they've all got problems, but they're also all fine as well. But I kind of steered him. I've never owned a Toyota or a Honda, and I steered Travis toward. I was like, hey, have you owned these? I did. I just think you just look at so let's look at the actuarial data, right?
Because I own an Acura. Which is a Honda.
Which is a Honda. Yep. Great.
Why would you not want to own a Toyota or a Honda?
No, I said I would. I just never.
I thought you said you've never owned one, but you would.
I've never personally owned those two brands.
Gotcha.
But I would always steer people toward them because I just think the data's the data. They, they run a long time. That's just the way it is. I just think they build a better car, although they've had some recent issues, but again, everyone has. They're great, just statistically speaking.
My Acura is great until a daughter learning to drive accidentally goes forward instead of in reverse and runs it into the garage wall. You wouldn't know anything about that either, would you?
It sounded like mine was way worse.
I don't know.
She broke the rear tires loose because she was on the gas as we were crushing the boxes that we hadn't unpacked yet into the wall. And then now if you actually look close, you can see where the fresh paint is. But that was a $2,000 mistake.
Well, this was a little love tap, but it was a $4,500 fix. Yeah, we just got it back 2 days ago.
All the sensors and
I only paid because the radar sensors in the front, all that crap. But I only paid the deductible, of course.
The deductible, right?
And I have high deductible. I have $1,000 deductibles instead of $500.
Same.
Yeah,
same. Yeah, so I think I paid the deductible for the vehicle, and then I had to pay another. I don't know what it was. Remember $1,500 for the wall repair, paint, sheetrock, drywall, all that jazz.
Yeah, that's funny.
And then not to dime her out, but she was backing in the Tesla out of the garage the other day, and she clipped the driver's side mirror.
No.
So now I think I can buy just this black trim piece and just, snap it back on, but I'm not sure. I haven't looked at it that close yet. So that was the other day. I was like, oh my goodness, kid. Maybe you shouldn't drive.
Maybe you should. Maybe the Tesla should just drive you everywhere.
Yeah, just.
Yeah. So I think what we really got from this is a lot of times in the IBC crowd, and I think maybe we are guilty of this a lot too, where we just, we're really focused on the numbers and what's the most optimal use of every dollar, which is very important, right? And all else being equal, you should do what's most optimal for your money and most efficient. However, it's not always everything is equal. Sometimes there's considerations like, is my wife and kids going to be safe in this vehicle? So there's other considerations on top of that, and being flexible for that. So the risk is don't get so focused on the system that you lose sight of why you built it in the first place.
Oh, I love that.
Right? That's why we built it. So we have these options to take care of our family. Like, I think maybe I brought this up last episode, but, I was able to because I have access to capital. I don't have health insurance per se. I am a cash payer, but I have a crowdfunding, source that I partner with. I was able to send my son to the knee surgeon, the orthopedic surgeon of our choice, not the one that was the cheapest one who's 500 miles away that we have to travel and stay overnight for and just get the procedure done as cheap as possible. We got to use the one, I had the ability to give my son that option. And we never know when those opportunities or emergencies or whatever they may be, we never know when that's going to happen, which is why it kills me when people say, I don't need that much money, or I'm not going to need that much money when I retire. I don't care that much. I don't need to leave my kids that much. Well, I was just watching a documentary over the weekend called The Hollywood Hustle about this dude who's total fraudster and whatever, making millions per year. But then his wife, all this stuff came out and his wife was left essentially destitute and had to move out of this $5 million Beverly Hills mansion back into her parents' basement, right? Why wouldn't you want, like, her parents, this girl who had to move out of that house back into her parents' basement, her parents now had to fight the courts, had to fight him in court.
Right.
And they had to spend a ton of money to do that. How do you know that that's not going to happen to one of your kids where they're going to need your support and spend tons of money to go fight their ex in court to win custody of their children. Like, do you want to be prepared for that or not?
Well, that literally happened in my own family. I had to help my sister out. Now, it ended up being a huge cost, but I paid for it, right? And I'm not going to disclose how much it was or anything, but I had the capital and the dry powder in order to do what's best for my sister and my niece and my nephew. And it worked out, and they're thriving and in a far better position than they otherwise would have been. So it does happen. And I didn't plan on that. I wasn't like in my investment portfolio, like, hey, let's go do this. Let's interrupt the
is that something
compounding
you would have thought of if all you had was money in a qualified account locked up? Would you have even considered, just liquidate my retirement account and go do this?
Yeah. Or it would have been a large, several large credit card swipes or something, which I'm sure they would have tacked on fees at the law offices and stuff. But
right.
It ended up working out differently, and I'm thankful for that. So
yeah. Well, there you go. So it's not always about the math. The math is very important, but it's not always about the math.
Yep. Yeah. And I'm holding up, if you're watching on YouTube, I'm obviously holding up a copy of Becoming Your Own Banker, 5th edition. And somewhere in this book, I can't quote the page number, but Nelson says something to what you were just saying, that, you're never going to complain about having too much capital or too much money available to you. You're never going, and like use this, quote, I think Dan Sullivan was, if you have enough cash to solve a problem, then you don't really have a
right.
You may have a problem in other way, but at least you can solve it financially, right? So, and again, can't harp on it enough. The future is unknown. Like, you have no idea what's going to happen.
No idea.
Just think about that. I know you think this is the way it's going to be, and if it works out like that, great.
Right.
But you're really rolling the dice. So just keep that in mind.
One WhatsApp thread, one car problem, 7 different answers. And every single one of them was thinking about capital completely different than the average person.
And that's what the IBC community actually looks like. It's not a bunch of people memorizing some playbook, people running real numbers in real life and disagreeing on the best path to get there, because the system is flexible enough to support different answers.
Travis got math, he got tax advice, he got engineering perspective, and he got Antonio reminding him what money is actually for. That's a financial education in one thread.
And Stacy went on to prove it with years of receipts. Sometimes the cheapest option up front becomes the most expensive option later on down the road.
If you're in a group chat full of infinite banking people and you've got real life money questions, that thread is worth more than any course you could take. Whether you're a part of one of those threads or not, join us in our school community. Real stories from real people practicing infinite banking in their lives.
If you like what you heard, go to the wealthwarehousepodcast.com and schedule some time with either Dave or me so we can discuss your IBC future.
And until next week, control your capital.
Or somebody else will.